When the country that used most of the world's money starts needing the world to keep believing in its money, you are no longer living inside a permanent empire. You are living inside a negotiation. Most people will miss that because they are trained to look for a collapse. They want the movie version. They want a single headline, a single panic day, a single moment where someone rings a bell and declares that the dollar is finished and the old world is over. That is not how serious systems change. Serious systems do not usually explode all at once. They thin out, they dilute, they lose exclusivity before they lose relevance. They go from being the only table in the room to being the biggest table in a room that suddenly has many tables. And if you do not understand that distinction, you will make the exact mistake that destroys more wealth than panic ever does. You will either underestimate the change or you will overreact to it. I have spent my life studying how capital behaves when the ground beneath it begins to move. Not when the newspapers are calm, not when the slogans sound reassuring. When incentives change, when confidence gets repriced, when one generation realizes that the rules that created the last half-century are no longer guaranteed to create the next one. That is where we are now. The real story is not that China woke up one morning and decided to dump the dollar in some dramatic gesture. The real story is that the world has been quietly testing life with a little less dollar dependency, a little more regional trade, a little more gold, a little more local settlement, a little more optionality. And once a system built on habit starts being tested by alternatives, the most important thing for an investor is not outrage. It is adaptation. You have to understand what the dollar actually gives. After the Second World War, America did not simply become rich. It became structurally central. The dollar became the language of trade, the deep pool where global savings hid, the unit that settled oil, debt, and fear. That arrangement gave the United States an advantage so large that most Americans stopped seeing it. When the whole world wants your currency, you can borrow more cheaply than your discipline deserves. You can run deficits longer than a normal country could survive. You can print more than a smaller power could get away with. You can be sloppier than your balance sheet should permit, because demand for your paper keeps extending the runway. That privilege was never magic. It was a bargain. The world accepted dollar centrality because the United States offered liquidity, legal depth, military protection of trade routes, and the largest investable capital markets on earth. As long as the bargain felt superior to every alternative, the system held. Now that bargain is still powerful, but it is no longer uncontested. That is the part people refuse to think through. They keep asking the wrong question. They ask whether the dollar is about to die. That is a lazy question. The right question is whether the world needs the dollar a little less than it used to. Because if the answer is yes, then the next decade does not need a dollar funeral to produce very different winners and losers. It only needs a slow reduction in automatic demand, a modest increase in alternative rails, and a world where capital begins to compare instead of obey. That is already enough to change the game. Look at what happens whenever trust in the old center weakens even slightly. Central banks buy more gold. Countries experiment with bilateral settlement in their own currencies. Payment architecture gets built outside the old channels. Trade blocs start asking what happens if they do not want to be as exposed to another country's sanctions, politics, or monetary inflation. None of that has to succeed completely to matter. It only has to chip away at monopoly. And monopoly is what gave America the easiest version of its own financial life. If I own the only bridge across the river, I can charge whatever I want and sleep well. If suddenly there are 3 smaller bridges downstream, I may still own the biggest bridge, but my power has changed. My toll can no longer be assumed. My pricing becomes a negotiation. My dominance turns from absolute to relative. The bridge is still valuable. It is simply less magical than it used to be. That is I want to be very careful here because serious investors lose fortunes when they replace nuance with theater. The dollar is not disappearing tomorrow. It is still overwhelmingly embedded in global finance. It still sits at the center of foreign exchange transactions. It still dominates global payments. Treasury markets are still deeper and more liquid than anything approaching a true alternative. America still owns a huge share of the world's innovation stack in artificial intelligence, semiconductors, software, biotech, and capital formation. When fear spikes, money still runs toward the United States far more than it runs away from it. That means you do not position for some fantasy of immediate replacement. You position for dilution. Those are not the same trade. An immediate replacement story tells you to do something theatrical. Sell America. Buy whatever sounds anti-American. assume one dramatic geopolitical move changes the entire architecture of trust. That is how amateurs think. They jump from one extreme certainty to another. A dilution story is more disciplined. It says America is still formidable, still central, still rich, still innovative, still investable, but it will likely capture a smaller share of the world's future growth than it did when it faced fewer credible alternatives. It says assets can continue to compound while also delivering lower relative returns than investors became accustomed to during the era when almost every road still led only here. It says the United States may remain first among powers without remaining the only power that matters. That is a very different world from the one most portfolios are built for. Most people do not know how concentrated their assumptions have become. They think they are diversified because they own an index fund, but an index fund built inside one country is still a one-country bet. A retirement plan built on one reserve currency is still a one-currency bet. A lifetime of home bias wrapped in patriotic language is still home bias. It feels safe because it has worked. That is exactly why it becomes dangerous. Every long cycle eventually creates a generation that mistakes familiarity for inevitability. If America led for decades, they assume it must lead forever in the same proportion. If they assume no meaningful erosion can occur without total collapse. If U.S. stocks outperform for most of their investing lifetime, they assume the future owes them the same sequence, simply because the past delivered it. Markets are not sentimental. They do not reward nostalgia. They reward correct adaptation to changing marginal conditions. And the marginal condition is what matters most here. If the world moves from a system where the dollar is mandatory to a system where the dollar is preferred but negotiable, that marginal shift can change flows, valuations, and expected returns across an entire generation of assets. It can change where reserve managers park new money. It can change how commodity exporters settle trade. It can change how emerging markets think about debt vulnerability. It can change how multinational companies hedge, where they source, how they borrow, and which geographies investors are willing to pay up for. This is why the phrase changing world order, even though most people abuse it, a changing world order does not mean the old order has vanished. It means the old order has lost the luxury of being unchallenged. The investor who sees that early has one enormous advantage. He stops treating the past as a forecast and starts treating it as context. Now let me tell you where I think many investors will get this badly wrong. They will overreact to the headline and underreact to the structure. They will talk endlessly about whether China will overtake the United States in one specific year, whether some BRICS payment experiment is fully functional yet, whether some digital settlement rail is ready to replace the existing plumbing tomorrow morning. All of that creates noise. Some of it matters on the margin. But the deeper issue is not one country winning a beauty contest. The deeper issue is that global growth is broadening, demographic energy is shifting, and the center of gravity of demand is no longer as concentrated as the last 50 years trained you to expect. India matters. Southeast Asia matters. Parts of Latin America matter. Resource-rich regions matter. Commodity chains matter. Energy security matters. Supply chain redundancy matters. The people who think this entire transition can be reduced to a China versus America boxing match are using a very small map to describe a very large planet. The more accurate picture is that the world is becoming more multipolar in production, consumption, bargaining power, and financial ambition. The dollar can remain the leading currency in a world where America owns a smaller fraction of the next wave of growth. Those two facts can live together. In fact, I think they probably will for a long time. That means your investment response must do two things at once. You must continue to own the best of the United States. And you must stop pretending that the United States alone is the whole future. The first mistake would be to abandon America. The second mistake would be to marry it blindly. Most people will choose one of those two errors because certainty is emotionally comforting. Thoughtful allocation is not emotionally comforting. It demands proportion. It demands living with a world that is neither collapsing nor staying the same. That is why this period will make some people very rich and leave others confused for years. The confused investor wants a slogan. The disciplined investor wants a framework. So let me give you the framework I would use if I were forced to prepare a serious family portfolio for a decade defined by dollar dilution, broader world growth, and more fragmented financial power. The first principle is that you do not defend yourself against a weakening monopoly by holding more claims on the monopoly alone. If America's share of future growth may be lower than its past share, then a portfolio that is almost entirely U.S. large-cap equities is not conservative. It is concentrated. I do not care how familiar it feels. Concentration wrapped in habit is still concentration. You need a deliberate non-U.S. sleeve. Not because the U.S. is broken, because the world is bigger. That means owning broad international exposure with a real willingness to let other regions contribute to returns. It means accepting that lower starting valuations abroad can matter. It means understanding that a weaker dollar can improve the dollar. Translated returns of foreign assets, even when their local returns are merely decent rather than spectacular. It means you stop thinking of international allocation as a charity project and start thinking of it as an admission that capitalism does not respect national nostalgia. The second principle is that if reserve diversification is real, then neutral stores of confidence matter more. Gold is not productive in the way a business is productive. I understand that. I would still rather own a wonderful business than a shiny object over a very long horizon. But there are periods when monetary distrust itself becomes an asset class. When central banks begin buying gold aggressively, they are telling you something. They are telling you that political neutrality, sanction resistance, and non-printability still matter in a world full of paper claims. That does not mean you bet your future on gold. It means you respect what gold is signaling. In a decade where confidence is being redistributed, a modest allocation to monetary hedges stops looking eccentric and starts looking prudent. The third principle is that if the world is becoming more multipolar, then real assets and scarce inputs deserve more attention. A more fragmented world is usually not a cheaper world. It is a world with more duplication, more redundancy, more security spending, more domestic capacity building, more supply chain buffers, more commodity competition, and more pressure on physical things that cannot be conjured with a keyboard. That includes energy, industrial metals, copper, selective commodity exposure, and the infrastructure required to move, refine, store, and protect them. I am not talking about chasing every cyclical spike like a speculator with a microphone and a caffeine problem. I am talking about remembering that when paper systems become less simple, hard assets quietly regain status. The fourth principle is that America's continued strength should not be abandoned. It should be upgraded from a default assumption into a deliberate selection process. The old lazy trade was to own the U.S. because the U.S. was the whole story. The next decade will require something sharper. You want the parts of America that continue to benefit from innovation, productivity, capital depth, and global software. Like economics, you want businesses with pricing power. You want enterprises that can still compound in a world where currencies move, trade blocks shift, and costs do not stay obedient. You want intellectual property, platforms, payment networks, mission, critical software, productive infrastructure, and selected areas of science and industrial technology. That is very different from just owning the broad market and assuming broad valuation expansion will rescue laziness forever. The fifth principle is psychological, and it may be the most important of all. You must train yourself to distinguish between dilution and disaster. A country can lose relative dominance without becoming uninvestable. A currency can lose share without ceasing to matter. A market can deliver lower returns than its golden age without becoming a wasteland. If you do not understand that, you will lurch from complacency to hysteria and back again. That is how capital gets chopped to pieces. First, people assume the old regime lasts forever. Then they panic into the first anti-regime story they hear. Then they crawl back into the familiar after they have already done the damage. A serious allocator becomes harder to shock because he lives in proportions, not slogans. Now let me tell you where the real identity shift happens for the individual investor. For most of your life, especially if you are American, you were allowed to think like a citizen first and an allocator second. The same country paid your wages, anchored your retirement plan, dominated your portfolio, protected the reserve currency, and led the innovation cycle. Patriotism and portfolio construction rarely came into conflict because the same machine powered both. That becomes less true in a world where the machine is still strong, but no longer singular. At that point, you face an uncomfortable question. Are you building a portfolio to defend a familiar story or to survive and compound through a changing one? Those are not always the same thing. A lot of people will fail this test because they are secretly trying to preserve emotional certainty. not grow capital. They do not want to learn a wider map. They do not want to admit that the old center can remain important while still owning less of the next chapter. They do not want to hold emerging markets because emerging markets feel messy. They do not want to hold gold because gold feels old fashioned. They do not want commodities because commodities feel volatile. They do not want non-U.S. equity because foreign accounting standards, governance, and politics feel unfamiliar. They do not want any of it. What they really want is the last 20 years again. That is not a strategy. That is grief disguised as investing. The investor who wins the next decade will be the one who can do something subtler and more mature. He will say, yes, the United States still deserves a powerful place in the portfolio. Yes, the dollar still deserves respect. Yes, American innovation remains extraordinary. And yes, the world outside America now deserves a larger share of my attention than my habits used to give it. That is how capital behaves when it grows up. I also want to say something about fear because fear is cheap right now. Whenever you hear people talk about the end of a monetary era, they tend to reach for the most dramatic image available. They imagine confiscation, overnight reserve collapse, sudden hyperinflation, a world where every supermarket shelf becomes a monetary documentary. Those fantasies sell because they flatter emotion. They do not help with asset allocation. The more probable reality is slower and therefore, to many people, more dangerous. The more probable reality is years of lower relative U.S. outperformance, years of broader international contribution to returns, years of commodity and real asset relevance reasserting themselves. Years where a weaker dollar makes foreign earnings translate differently. Years where the reserve share of the dollar erodes around the edges while its transactional dominance remains large. Years where America is still first class but no longer alone at the table. That slow version is harder for people to see because it does not announce itself loudly enough to trigger an instinctive life change. It just quietly changes the arithmetic. And arithmetic, not drama, is what compounds. If you want a simple image, here is the one I would use. Imagine you own a magnificent department store in the center of town. For decades, every road, every tram line, every parking garage, every tourist bus, and every map points customers toward your front door. You become so successful that you begin to confuse your own success with geography itself. Then one day, not one day in the dramatic sense, but one decade in the real sense, new roads get built, a rival shopping district grows, new train lines connect neighborhoods that used to depend entirely on your block. You are still the best-known store in town. You are still profitable. You are still crowded. But fewer people are forced to come only to you. What happens next? If you are foolish, you say nothing has changed because your shop is still full. If you are panicked, you sell the store because competition exists. If you are wise, you keep the great store, buy the new roads, own some of the rising district, acquire the warehouses that serve both neighborhoods, and stop acting as though one address is the whole city. That is the allocation problem in front of us. Now let me translate all of this into a more practical blueprint. I would want a core U.S. allocation because I do not bet against America's ability to innovate, attract capital, and adapt. I would want a meaningful international developed market allocation because valuation, currency translation, and geographic diversification all matter when a dominant currency begins to lose some exclusivity. I would want a real emerging market sleeve, not because every emerging market is wonderful, but because demographic expansion, manufacturing migration, technology adoption, and lower starting valuations create asymmetry that one country portfolios miss. I would want some hard asset and commodity exposure because fragmented geopolitics and monetary dilution tend to reward scarcity differently than the disinflationary globalization of the old era did. I would want some gold or monetary hedge exposure because central bank behavior is telling you that trust itself is being repriced. And inside the U sleeve, I would want genuine quality, not lazy index dependency on whatever happened to become large. That is not sexy. It is not clickbait. It is not the kind of sentence that gets applause from people who want a single ticker and a single villain. It is how real capital survives regime drift. I have lived long enough to know that history rarely repeats exactly and often rhymes with irritating precision. The rhyme here is not that America suddenly falls off a cliff. The rhyme is that every era produces a moment when the winners of the previous regime begin to believe their advantage is metaphysical instead of conditional. That is when the seeds of reallocation get planted. Not because the incumbent is weak, because the incumbent has become so used to centrality that it forgets alternatives only need to become acceptable, not perfect. No alternative to the dollar needs to be flawless for the dollar to lose share. No foreign market needs to be superior in every respect for foreign exposure to become more rational. No commodity needs to become the center of the portfolio for real assets to matter more than they did in the easy years. No single emerging economy needs to replace the United States for emerging market exposure to deserve a larger seat at the table. That is the mental model. This is why I do not think the next decade belongs to the loudest patriot or the loudest pessimist. It belongs to the allocator who can hold two truths without feeling torn apart by them. America is still exceptional, and America may still deliver a smaller share of the world's future returns than it did during the period that trained your instincts. The dollar is still dominant, and the dollar can still lose relative share in reserves, trade settlement, and strategic confidence over time. Global diversification can matter more, and that does not require a bet on American failure. Gold can have a role, and that does not make productive assets irrelevant. Commodities can regain importance, and that does not mean you become a commodity speculator. Once you learn to live with both sides of each sentence, you become much harder to fool. That is the real wealth opportunity here. It is not just in the assets themselves. It is in acquiring the correct map before everyone else realizes the old map was too small. People always ask for the single trade. They should be asking for the single discipline. The discipline is this: when the world shifts from one center toward several, do not marry the old center, and do not worship the new ones. Own the best of the incumbent. Own the rise of the challengers, the stores of confidence and the scarce inputs that a more contested world will need. Then let time, valuation, and discipline do the heavy lifting. That is how wealth is built when history gets less simple. And let me leave you with the only test that matters. If the dollar is not about to die, but is slowly becoming less singular, if America is not about to disappear, but is slowly becoming one great pole in a wider field, if the world is not ending, but is quietly redistributing power, then ask yourself one brutally honest question: is your portfolio built for the world that made you comfortable, or for the world that is already replacing it? One of those portfolios is built on memory. The other is built on reality, and over the next decade, reality is the one that will compound.